Hello and welcome to the Financing a Sustainable Future podcast, brought to you by the Initiative in Sustainable Finance, funded by the Global School of Sustainability here at LSE. I'm Tom Gosling, Professor in Practice and Director of the initiative. This is a podcast where we talk to LSE academics about their research on sustainable finance in a way that is accessible for practitioners. Today I'm here with Alperen Gözlügöl, Assistant Professor in the Law School here at LSE, to discuss his paper Credit Substitution in Sustainable Finance, an Achilles heel. So Alperen, a very warm welcome to you. Let's start with the motivation behind this paper. What drew your attention to the issue of credit substitution in sustainable finance, and what gap in the literature are you trying to fill?
Many thanks, Tom, for inviting me. It's my pleasure to be here. The motivation for the paper comes from observing that sustainable finance has become actually mainstream, with governments, regulators, and financial institutions increasingly using finance flows as a lever to push real economy firms towards net zero and broader ESG goals. Yet despite this enthusiasm, I felt there was a missing link in the literature. Much of the focus has been on disclosure, taxonomy, green bonds, and so on, but not enough attention has been paid to what happens when a financial institution exits a brown asset, or let's say refuses to finance further, and the firm simply finds another lender or investor. That is essentially what credit substitution is. So the gap paper seeks to fill is bringing this credit substitution into the sustainable finance narrative, showing how exit of one creditor does not necessarily translate into reducing financing of brown assets if substitution is possible. The aim is to surface this under-recognized dynamic, explore its implications, and also especially consider the regulatory ecosystem that enables it as a legal scholar.
So, as you've mentioned, credit substitution is a familiar concept in finance, but you argue it has unique implications in sustainable finance in that context. So could you briefly explain how that is and how it could be an Achilles heel for sustainable finance?
Sure. So credit substitution is the concept that when a firm faces the withdrawal or retraction of one form of financing, it can switch to another firm or another provider, essentially substituting one credit source for another. In general, we have seen this around changes in bank regulation, the rise of non-bank financial intermediation in the period after the global financial crisis. What I argue in the paper is that in the sustainable finance context, this becomes particularly problematic when a lender or investor withdraws because of brown exposure. The assumption is that the firm will either have to invest less in brown assets or face a higher cost of capital. But if the firm simply finds another lender who doesn't impose the same sustainability constraints, then the effect vanishes. In that sense, credit substitution becomes an Achilles heel because the exit still happens, but the real economy effect is diluted or disappears altogether. Moreover, from a risk perspective, in terms of financial risk associated with lending lending to or investing in brown assets, the risk is not eliminated, but it just migrates to another part of the system. And if that part is less regulated or less transparent, the financial stability implications would be significant. So sustainable finance policies may be promoting exit by some institutions, but without checks on where the credit goes next, the policy's real-world impact might be very limited.
That's extremely interesting. And you present a wide range of empirical evidence showing how credit substitution plays out in sustainable finance in practice. What are some of the most striking examples that illustrate the problem?
Yes, so I draw on a wide range of empirical and anecdotal evidence showing how substitution already shows up. This evidence relates to transfers by banks of their exposures to fossil fuels, either via loan sales, securitizations, or synthetic risk transfers to manage the transition risk and brown exposure. There's also some evidence on private credit funds lending to projects shunned by banks, and also some evidence on substitution between banks and bond market. Some striking examples to me relate to substitution between banks due to differences in the regulatory and broader ecosystem that they are subject to in terms of sustainability pressure. There are two examples in the US and Brazil where relevant regulatory measures only targeted a subset of banks, and their exit was then followed by entries of non-targeted banks. There seem to be also important cross-jurisdictional differences, as a study looking at the syndicated loan network among major international lenders, finds strong substitution between banks from different regions. In particular, it finds that US, Japanese, and Canadian banks are key to sustaining the syndicated fossil fuel lending market as others, for example, European banks, are exiting.
So we're going to dig into each of these because you broadly identify three drivers of credit substitution. One is simply the range of different financing channels, actors and mechanisms that exist. Another is regulatory differences across regions, and you've touched on both of these. And then a final one is regulatory differences between sectors within a given region. So let's discuss each of these in turn. So one very prominent channel for credit substitution, which you've touched on already, is the switch from bank to private credit in fossil fuels. Could you just expand a little bit more on this and why it happens?
Yes, so bank private credit substitution channel is quite visible and important when banks decide or are pressured to reduce their exposure to fossil fuel companies, for example, coal mining or carbon-intensive oil and gas. Those firms might lose their financing from traditional bank lenders. At the same time, private credit funds or similar non-bank lenders, which might face less pressure, regulatory pressure, fewer disclosure obligations or supervision, may step in to fill the financing gap. The reasons this happens include, for example, banks responding to stakeholder or regulatory pressure, banks facing high-risk assessments for their brown assets, banks wanting to reduce their transition risk or reputation risk. Non-bank lenders, such as private credit funds, may be less constrained in some of these aspects and have possibly different risk appetite. So they see an opportunity to lend and possibly to demand higher yields. The substitution means that the fossil fuel firm continues to get credit and the bank exit is less meaningful in terms of real economic transition, and the risk associated with lending migrates to less regulated entities. Given little transparency on private credit lending, it is really hard to measure the extent to which and under which conditions this substitution from banks to private credit occurs, but there are indeed reports that private credit funds are replacing European and also some US banks that are retracting from coal, oil and gas financing due to regulatory and reputational concerns.
Yes, I mean, it's a sort of classic case of squeezing on a balloon. It just kind of comes out somewhere else. And so these attempts to sort of bear down on the more kind of, if you like, malleable sectors of, banks are very prone to kind of stakeholder pressure. You could argue that's a waste of time if you get this displacement. But there has been, some suggestion, there's quite a prominent paper by Daniel Green and Boris Valley, which came out last year or maybe earlier this year, that bank lending policies have actually put the squeeze on coal financing, at least to some degree, because the relationships are quite sticky. So how do we, you accept in your paper that there's sort of mixed evidence. How do we reconcile the conflicting evidence in this area?
That's a very good point. And as you said, my paper indeed acknowledges that the evidence is mixed. There are indeed some papers in the literature that show that creditor exits are not followed by substitution, like the Green Valley study you mentioned, but they're actually in the minority. It is not really easy to reconcile the conflicting evidence because studies do not give away why they find different results, apart from the fact that they look at different contexts. This might be actually one important reason, looking at different contexts, because whether creditor exits are followed by substitution or not is very context specific. It will depend on firms' access to other funding sources, which might be a function of the size, sector, assets, and what actually drove the exit decision of creditors in this case. For example, studies that examine coal as a finance asset might find different results compared to other studies on other brown assets, such as oil and gas, because exit from coal as an energy source is more widely expected in some developed countries across market participants, and regulatory signals are much clearer. And banks might be exiting actually because funding coal is not a profitable business anymore, which is the common denominator across all financial sources. So you would not expect creditor substitution. It does not simply make financial sense. But let's say you exited lending to coal development in China or India, chances are you're going to be substituted as there is still demand for coal there. So long story short, theoretically, we know that credit substitution or creditor substitution is possible, but the internal and external validity of empirical studies will be limited. In other words, they will struggle with establishing a cause and effect relationship. The difficulty lies in endogeneity, namely what caused a financial institution to exit, and also causality, meaning what the impact of this was on the firm decision-making and behavior. And external validity is also limited because, as I said, results are very context-dependent.
I mean, I completely agree with what you said there about the Boris and Valley paper, because I think it's quite. I think the circumstances of coal, particularly in developed markets, are really very specific, and I think we need to be super cautious about extrapolating from that, to oil and gas, or or even coal in emerging markets. I think that's a very very valid point that you make there. So turning to regional differences, can you give an example of how regulatory differences between regions have facilitated credit substitution?
Yes. So generally, when you look at the major financial centers around the world that are home to the largest capital markets and banks, so EU, US, UK, and in Asia, China, and Japan, it is difficult really not to notice the stark differences in how they approach sustainable finance. In other words, how regulators and stakeholders in those jurisdictions put pressure on financial players to adjust their decision-making in terms of climate goals. It is difficult to come up with hard classifications of these jurisdictions as the situation is shaped by the relevant political economy, but it seems that EU and UK banks, for example, are under increasing regulatory and non-regulatory scrutiny, while US banks do not receive the same treatment, and China and Japan seem to follow their idiosyncratic interests and policies. So these differences are highly conducive to credit substitution across regions. In a way, the promise of sustainable finance, which is its cross-border nature, also creates a peril in the form of international credit substitution. This creates a situation where a European bank might reduce exposure to brown assets, but a non-European bank or lender from a less regulated region might pick up that exposure. Indeed, there are increasing signs that while European banks gradually withdraw from fossil fuel lending, North American and Japanese banks are taking the lead, accompanied by a dramatic increase in lending by regional mid-sized banks. In the US especially, regional banks from states that have introduced anti-ESG laws are stepping up their fossil fuel lending, noting much more opportunities in the fossil fuel industry. Similarly, as an example, Australian coal miners tapped Japanese and Chinese lenders for loans after Australian banks exited new coal financing.
Yeah, I mean, I guess some of these geographic differences have been really obvious to us in the last couple of years. But you also point out in the paper that regulation can create arbitrage opportunities even within regions. And I mean, the EU has arguably the most advanced sustainable finance framework in the world. And yet you suggest even here, differences between bank and market finance regulation create substitution risks. Can you just elaborate on this?
Yes, so this is a subtle but important point indeed. So the EU has built one of the most sophisticated regulatory frameworks for sustainable finance. So many directives and regulations that we are familiar with: Corporate Sustainability Reporting Directive, Sustainable Finance Disclosure Regulation, Taxonomy Regulation, etc. But even within the EU, different parts of the financial system are regulated differently. For instance, banks face one set of rules under banking regulation, supervision, capital requirements, etc., while funds or non-banks, which we can call market-based finance, have a different regulatory regime, for example, under the Sustainable Finance Disclosure Regulation. Because of these differences, the cost, incentives, risk assessment, and regulatory pressure differ. So a bank may reduce lending to a brown asset, but the market, whether bond investors or private credit funds, may not face equivalent pressure or might have a different risk-return calculus. So thus, substitution from bank to market finance is possible even within the same jurisdiction. This internal regulatory arbitrage means that even ambitious regulation does not really guarantee no substitution unless it covers all channels equivalently. So I discuss various differences between bank-based finance and the regulation of banks and market-based finance in the paper in the EU. But let me draw your attention to a significant one: transition plans. Under the latest banking package, EU banks will be required to draw up prudential transition plans that detail how their business models align with climate targets and how they intend to manage their exposure to high-emitting sectors, these plans will sit at the core of prudential supervision. Supervisors like ECB and national authorities can assess them, challenge assumptions, and if necessary, even impose penalties and additional capital requirements. In other words, there is a real supervisory leverage. By contrast, many non-bank and market finance actors such as investment funds, private credit vehicles, or bond investors do not face yet equivalent obligations. The Sustainable Finance Disclosure Regulation only requires disclosure about sustainability risks, but it does not mandate that these firms actually have or implement transition plans, nor does it empower supervisors to intervene if their exposures remain misaligned. So there is a transition plan requirement actually under the Corporate Sustainability Due Diligence Directive, but the way it will be implemented and enforced for asset managers seems a far cry from the requirements and their supervision for banks. So the outcome in the EU is an uneven regulatory landscape. A bank may feel real pressure, regulatory and supervisory, to limit lending to a fossil fuel company or tighten to its portfolio alignment, but that same company can then issue a bond or obtain private financing from an entity that does not face comparable transition plan scrutiny or supervisory oversight. So even within the EU, the financing might simply migrate from the regulated banking channel to less regulated parts of the system.
Yeah, I mean, this creates a real challenge, doesn't it, for regulators who tend to be sort of slightly siloed in how these regulations get approached. So if credit substitution undermines potentially both sustainability goals and financial stability, what do regulators need to do differently? Are there specific reforms you'd advocate?
In the paper, I outline several regulatory and policy implications. First and foremost, a key suggestion is to level the playing field across financial channels. Regulators should avoid creating rules that target only one subset, for example, banks, while leaving others unchecked. Policies should look at all relevant credit providers. Otherwise, regulatory goals, whether it is financial stability or better environmental impact, will be undermined. So policymakers or supervisors would be wise to consider and monitor not only the first-order effects of their interventions, but also second-order effects, such as whether it leads to decarbonization or credit gets substituted, or whether it leads to build-up of climate-related financial risks in the non-regulated sector. So far, this has not been apparent. This is not to say that the regulatory treatment for banks and market-based intermediaries should be necessarily the absolute same, as there are justified differences from a prudential perspective, yet the second order effects should be at least on the radar of regulators or supervisors. I also provide some concrete implications, but rather negative ones, considering the capital adequacy rules or proposals for introducing green supporting or brown penalizing capital regimes. It seems to be a bad policy because it is highly likely to lead to credit substitution, because banks will exit brown assets without establishing any increase in their riskiness, which risk-return oriented investors will gladly finance. Furthermore, reviving securitization seems to be important on the regulatory agenda, especially to support bank lending and growth, also in relation to green transition, but it is a double-edged sword. Securitization is one of the primary ways whereby credit substitution can happen, and facilitating or easing conditions related to securitization might actually increase the activity on brown assets on banks' books as they move to satisfy supervisory and stakeholder expectations. Lastly, because substitution can happen cross-border, as we talked about, regulators should also work internationally, for example, via the Basel Committee on Banking Supervision, to align frameworks and prevent regulatory arbitrage.
The point you make around green supporting factors, I mean, listeners can go back to the first episode in this series with Martin Umker, where he discusses his paper that absolutely addresses those kind of problems and potential unintended consequences of trying to promote sustainable lending through that mechanism. You finished on this point of international coordination, and it's one of those things that seems incredibly desirable, even essential, but incredibly sort of elusive. What prospects do you really see for aligning sustainable finance regulation in today's environment?
Yes, this is indeed a very crucial challenge. The paper highlights that financial markets are global and firms and lenders operate across borders. So even strong national or regional regulation can be undermined by a weak link elsewhere. So international coordination is necessary. But as you noted, it is difficult. Some prospects included voluntary initiatives like the Glasgow Financial Alliance for Net Zero and its sector-specific alliances, which, however, currently collapsed due to political headwinds. At the same time, formal regulatory alignment via bodies like the Basel Committee offers some promise, but progress is really slow and complicated due to national priorities. The paper argues that without more coordinated, enforceable frameworks, substitution will continue to be a problem. So while I remain cautiously optimistic because the pressure is increasing and climate urgency is raising the stakes, real alignment will require stronger institutional mechanisms, data sharing, and maybe even global standards. It won't happen overnight, but it is now more urgent than ever.
So for those advocating for sustainable finance as a route to accelerating the transition, what are the lessons from your paper?
For those who believe in sustainable finance as a tool for accelerating the transition, the central lesson from my paper, I think, is clear. Exit is not enough. It is easy to applaud a bank when it says it will stop financing coal, but the real test is what happens to that financing next. Will the firm lose access to funds, face higher costs of capital, change behavior, or will it simply find another lender? If we do not pay attention to this substitution, we risk celebrating symbolic victories while the underlying problem persists. Advocates need to broaden their focus from individual institutions to system of finance, channels, jurisdictions, actors, incentives. They should ask, is the financing genuinely constrained or just shifting? They could still advocate for exits because they simply drive some disutility by those financial choices, but then they should be cautious in terms of the effects attributed to those exits. In other words, they should maintain realistic expectations. Sustainable finance is a powerful lever, but it is not a magic wand unless the regulatory architecture and the channels through which finance flows are aligned. The hope for real economy impact might remain ultimately elusive.
Alperen, thanks. That's been a fascinating discussion, shining a light on what is clearly a profoundly important but perhaps under-discussed issue in sustainable finance, and highlighting some of the kind of opportunities and challenges to address it. So thank you very much.
Thank you, Tom. It was my pleasure to be here.
You've been listening to the Financing a Sustainable Future podcast with me, Tom Gosling. If you enjoyed the conversation, please like, share and subscribe on your favourite platform. To find out more about the work of the Initiative in Sustainable Finance, which is funded by the Global School of Sustainability here at LSE, please go to fmg.ac.uk/ISF.